first of all, good morning, and thank you all for joining us here today. It's a privilege to have all of you here. And allow me to introduce myself. My name is Dylan. I write for Nikkei Asia. They are basically the English arm of the Japanese Nikkei media group. And I suppose hardly a conference goes by these days where we don't have at least one panel dedicated to artificial intelligence. And here we are today. We're very privileged to have three very distinguished panelists here, both from the sides of consultancy and also from the money managing side to talk about artificial intelligence and how it relates to institutional investors. We have about 27 minutes left from the time that we walk from the backstage to the front, so that's 3 minutes just to sit down already. So let's make efficient use of time and see what we can get through today. Gentlemen, thank you for joining us here today. And I'd just like to kick off with a very basic question. How do you conceptualize AI in relation to your respective organizations, how you use it, and perhaps for those of you who are in the money managing side, how you can potentially place bets in this theme? We'll start with you, John.
Okay, great. Thank you, Dylan. Thanks for the invitation to participate on this panel. So at Albourne, we're a global alternatives consultant, and we don't manage any money, but we do use AI and machine learning in many parts of our business. Maybe just the journey to where we are now. So we've been in business for 31 years, and we have a development team on a global basis of about almost 80 folk. And within that team, 10 years ago, we formed a machine learning group. And so that was actually the end of their 9th year. So it's been a decade in the making, but it's been truly transformative in how we ingest data, process that data, analyze that data, and then the impact on our colleagues who are doing research and advisory work with our clients. So that was machine learning for the longest time, but then for the last 2 years, we've had an AI task force that we formed, AI policies around large language models and how we can adopt those in our business processes. And so they work very closely with our machine learning team, but I kind of draw from all the different business functions, investment functions and business functions globally. And so that has been a kind of a follow-on journey in terms of our sort of agentification of many aspects of the workflow of our colleagues who are doing IDD, ODD, quantitative due diligence, as QDD, and also on the portfolio advisory side. I can talk a lot more about that, but I'm conscious I've used up 4 minutes. So happy to dig into more about how we've evolved that policy over the last 2 years to really kind of build on the trust that we have in our colleagues to be able to use technology responsibly, but also to support the innovation internally. And it's been transformative in what we do.
And Dan, how about you?
Well, we're a systematic quant fund. We've been around for 30 years, so relative newcomers compared to John. But we have used artificial intelligence for quite a while. People act sometimes as though artificial intelligence is just LLMs or was just developed in the last few years. But of course, it has been around for a long time and in the applied field as well. The question is how you use it responsibly, because we've seen a lot of funds that sort of take the black box approach, and there's reason to be wary of that, not because black boxes are unpredictable, but actually the reverse. AI is extremely predictable if you let it manage risk, make decisions by itself, and so we stay away from that and instead use AI for optimization of known parameters and strategies, which is a safer path, you might say. In addition to which, we found tremendous efficiencies from using AI on the back-end operations, just because it can synthesize a huge amount of data extremely efficiently and help us essentially read hundreds of pages, even write hundreds of pages, or condense that. However, all of this is in the context of keeping AI, as we do, relatively firmly away from actually making decisions, in as much as AI is efficient at arriving to a conclusion, but it's almost always a conventional wisdom conclusion, and that doesn't make you a good trader.
Imran.
So we use AI 2 ways, right? One is for investment, like areas we're investing heavily on AI, and second is for how we can make ourselves more productive and efficient. On investment side, the way we are trying to play AI in 4 ways, right? So first 3 are kind of obvious. You need chips to build AI. Second, you need data centers. Third, you need power. The fourth one I think is interesting, probably many people find, that I like to call it AI arbitrage, because if you think about AI, you need a lot of data to be successful in AI. Data is the oxygen of AI. So without data, you cannot be. And then the second, I've seen that again and again in the last 25 years. A lot of companies build great technology, but a great technology means nothing unless you have a massive distribution. And so having a great distribution is powerful. And then the third, you need a technical team very strong this time around than building DoorDash or Uber, because AI is so technical. And so we're looking for companies that have strong data, have a lot of distribution, have a great technical team, but has not been recognized as an AI play yet. So those are the AI arbitrage. So that's how on the investment side, we're playing the AI. In terms of using AI in our own business, I think kind of like what Daniel, but I think one of the biggest areas that how can I improve productivity? Because our business is so much dependent on people, and it's really, really hard to find great people to your business who can make the investment decision. The talent is scarce. And so the question is, if I have great talent, can I increase productivity? And the other thing, the way the business has dramatically changed in last 25 years ago, you had to go to this user conference, analyst day, and trying to talk to as many people as possible. Now there is so much information publicly available through social media, through other places. So we're building a lot of listening tools and trying to figure out what's really interesting to you. Those are the kind of things we're building.
I'd like to pick up on Dan's point that AI has actually been around for a while now, right? I remember when I was previously in the past working for a stockbroking company where IBM was touting AI for the use of activities and operational efficiencies in companies. I think probably what many people think about now is how generative AI might help to revolutionize the asset management industry potentially, right? And we're still probably in the early innings of development. There's agentic AI that people are talking about now, and the very, very extreme end, potentially in the future, a super intelligence might come about in this area as well. Whatever the form may be, I think what's pertinent to note is that it's probably going to cut down in terms of the time and efficiency that companies can use this technology for. I just want to ask our distinguished speakers here about what you think about how it can potentially transform maybe in the areas of risk management choices and also in the area of asset allocation models that we're all usually used to. Yeah. John, would you like to start?
Sorry.
Oh,
I was just going to say, forgive me, that I think it's already made risk management much worse, and it probably will continue to do so for at least for a while until people come to grips with what AI can really do and what it can't do, or rather what it shouldn't be allowed to do. And a few years ago, at sort of the beginning of the LLM phase, a lot of new hedge funds came out, and many of them already don't exist because they gave people, and this happens in coding also, a sort of a false sense of empowerment at understanding things better than you actually do, being better than you actually are. And so it masks a lot of the inadequacies of underlying models and assumptions. And I think that we're still seeing that work through the system. It's early days.
Yeah, and maybe I'll just step back and kind of frame from our lens, just the level of adoption across different parts of asset management businesses. We were chatting before, I mentioned we've just completed the 3rd annual survey of asset managers in terms of their adoption of generative AI across their businesses, across different parts of the business. And so the first time we did it, which was sort of endpoint to endpoint 2 years ago, a lot of managers had felt like, oh, you're a little early, we're just starting to work out what we're going to do. This time, the average response was more, feels like it's almost too late. Like, isn't everyone using AI? But actually, when you dig down, just to give a sense of the scale, it's over 300 asset managers and so over $1 trillion of hedge fund capital, over $6.5 trillion of private market capital, and then with the financial conglomerate type asset managers, that brings the total to about 9 trillion of alternative assets that were in the survey. And basically, the area where there's the most adoption is actually within the investment process, and it's doubled from last year to this year. So from just over 30% to in the kind of just below 65%. And that's predominantly when you then dig down within the different parts of asset management, it's in the research due diligence phase, and far less when you go into risk management and decision making. Those become much lower. What I would say, a couple of observations as well within that data set, is that there's been greater adoption amongst private market managers versus hedge funds in terms of increase, but greater kind of in terms of level of reported gains of investment processes within the sort of the hedge fund space versus private markets. And but that's it's a key area. And then when it comes to actual adoption and agentification using semi-autonomous or autonomous agents, it's only about 21% of firms report that they're using agents on a semi-autonomous basis, and about 50% saying that they expect to, and they're doing research on rolling out agents, but they aren't yet. So that's sort of in the context. In terms of people's reservations, they've actually got slightly higher year on year, and actually the top reservation over the last 3 years had been data security, and now it's accuracy in terms of hallucinations has moved to be the biggest concern or drawback in terms of the utilization. But I think to that point around the final mile of decision making, there's still some hesitation. That said, we obviously been covering the hedge fund marketplace for over 30 years, and there are quantitative shops that have been using machine learning and AI actively on an autonomous basis within their models for many, many years, long before OpenAI kind of brought it onto our phones. So, yeah.
Imran.
So I'm more of a long short equity fund with 30 names or so. So we're not a quant fund. So the way I look at risk in my business, 5 different risks, right? We have stock picking risk. We have rotational risk, because we're a tech-focused fund. We have some sort of big drawdown because the world freaked out about whether it's a Japanese carry trade or something like that. 4th, macro, and the 5th is back office risk. So one of the things that we are using AI is really to make sure that my best talents are most productive, so that we don't, making single stock risk, because I think one of the biggest challenges as an asset management grower, and you guys know better than I do, is that, as you grow, you bring more people, and how can you make sure that everybody in your team, the quality is getting better, not quality is getting worse. And it's a very hard problem, and when I was at Snapchat, I built a business team from 50 to 3,000. It's just really hard to continuously attract great talent. And so to me, it's like, if I have great talent, how can you make them productive? And then, obviously, because it's a 30 names portfolio, from a risk management side, we don't use that much on AI, but we are using back office side, trying to make sure that we don't get fooled by, cybersecurity stuff and things like that, but very, very early, nothing crazy or anything. But the bottom line is, we want to make sure that we're a stock selection fund, bottoms-up fund, we pick the right stocks.
So I'm going to ask, I don't know whether this is a controversial question. You might answer it however each of you want. So we have the software that can help us right now, right? And does that mean that do we really need so many fund managers anymore? Do we have to pay them so much money? Or is there still a role for them? How much would you trust the machine to do the work for you? And I'd like you to take this as interpret this however you want and answer it however you want. Any of you, yeah.
I can go first.
Yeah.
So I think, fundamentally, alpha comes from you do something that's different than others, right? If everybody does the same thing, there is no alpha, because that becomes the average. So if everybody's suddenly saying, hey, we're going to do an AI model, first of all, the market going to create more volatility, because every trade going to be look like that, and it's kind of already happening through quant, and a bunch of other people look at the same factor risks. They buy this. Like recently, I got a software pitch that said, okay, they can look at my book and tell me that where I need to reduce my factor risk and things like that. So I'm like, okay, how many hedge funds they're using it? So like 250 of them. So they're all looking at, okay, you have too much NVIDIA, so maybe you should short this one. So then ultimately you lose the edge, right? So I think, so if everybody use AI, it's not. So you need ultimately human intervention to find the alpha. And I'm the biggest technology optimist in the world. So that'll be my thing. And the thing is that I always find people get over concerned about the fee, because ultimately you should care about how much you are generating net. So whether why do you care what fee you are paying? If you pay Renaissance 35% or whatever you paid and they generate the return, that's more than somebody is paying low fee. So I think the whole conversation about fee, I find it kind of like irrelevant as long as you have the return.
And I think AI actually increases the opportunity for managers to find alpha by understanding how other people are using it. You have insight now into part of the decision-making process, which is if everyone is using AI from a small number of platform providers, there are certain built-in assumptions that you can actually gain insight into once you understand how those models work. And that gives you an edge versus the people who are using it, at least the people who are using it more irresponsibly, you might say. Humans are much less predictable than machines, much less predictable than AI models. And you have to remember that LLMs are not designed to be good decision makers. They're designed essentially to come up with an average of human total experience and opinion. And if you ask a machine to 1,000 times over pick a number between 1 and 10 randomly, you'll end up with an even distribution between all the numbers, roughly speaking. If you ask 1,000 humans to pick a number randomly between 1 and 10, you won't end up with a normal distribution even. You'll have a lot of people picking 7. Some people will pick 1. 2 is also popular. 3, 4, not as popular. 5, a little more popular. 8 and 9, less popular. Why is that? We don't actually know completely, but every single person is different. And so if you assemble a human trading team, you've actually got that dispersion of opinion. If you have a machine trading team, all you have is the average built in.
Yeah, so I have an English accent, but I'm American. I'm based in the Bay Area, so I'm based in San Francisco, and so I spend a lot of time with friends who work at some of the big 3 AI firms in the US, and views about kind of where we're headed, how soon we'll get to ASI and other components, but they often do come up with this, which again, hotly debated, but it's clearly a reality that LLMs are very good at understanding what's happened, not necessarily at predicting where we go. When it comes to the impact on productivity of repeatable tasks in investment management, it's going to have a very profound impact of how we do our work. But in terms of the actual decision making and really kind of weighting the variables, I think there's quite a way to go. So in terms of, and I agree, at the end of the day, fees in this industry are supply-demand. We've advocated, that's what, it's how it shakes out. It's sort of capitalism. And ultimately, although we've advocated for better alignment, I don't think AI is going to drive material changes in what the best managers can charge and how things work. I think there'll be other forces that will actually have a bigger impact. I think the retailization and capital flows into alternative assets will be the single biggest driver of a change of return expectations and then what you can justifiably charge for returns. But AI itself, in the short to medium term, probably less so at this stage.
So I had lunch with the head of a family office a couple of months back, and he told me that, so how he's using AI at least is that he has entire portfolio composition, feeds it into the software, and then he instructs with a couple of prompts for the software to find blind spots or risks in the portfolio. And he tells me at least that he's quite impressed with what it's able to generate that he's not been able to see before. But just talking about blind spots, we're looking at the title of the panel here, AI in institutional investing. So it can be read as tapping the technology to make bets, and also the other side of it is making bets on the technology and the companies therein. So the last I saw, I think within Southeast Asia alone, after ChatGPT surfaced 2-3 years ago, there's now like 2,000 plus AI startups that have mushroomed in the region. Of course, VC funds and investors will be interested in seeing who's the next winner out of all these bunch, And I just want to pose a question here. Of course, within this space as well, I mentioned that we're still in early innings and looking to see how this may develop. But already, of course, there's market chatter of a bubble. When SoftBank sells a stake in NVIDIA, some people may panic. But I just want to get your thoughts on, the risks of the time that we're in right now in terms of placing bets on AI companies, not just in the public markets, but also those who are emerging from the private field. What are your thoughts on this, and how may we conceptualize the risks involved when there's still a lot of things to prove in this area? Anyone, yeah.
Well, we also have family office investment operations, which I direct, and we do have a particular investment thesis around AI companies. And the large hegemons, the OpenAIs and XAI and so forth, are deals that we stay away from, although we've been offered a chance to participate, just because they are doing a wonderful job beating each other down over fees in their own industry and racing to develop the latest tools. But the fact is that from a utility perspective, they're largely interchangeable. And if you have an application that is designed to rely on an LLM, except in relatively rare cases, can rely on any LLM equally well. So instead, we look for investment opportunities where the company has a niche application with a nicely protected moat around its customers, something that is more about the individual knowledge that arose from understanding their user base really well, rather than the actual AI tools that they're using. And so that's our focus. Another area that we're interested in, though, is definitely the infrastructure, because certainly we see tremendous demand for the power, the compute that is necessary to drive these new, less and less efficient models.
So I would say a few things. This is the third technology cycle I've gone through in my life. So first one was when people are building website. The second one was apps. And third one is this AI. So a few things that I learned, and I think that's going to be true this time around. So in technology, the early mover doesn't guarantee a success. Google was not the first search engine. Facebook was not the first social media companies. Yeah. So early adopting something or early to market doesn't necessarily guarantee you success. So that's number one. Number two, I think I have fundamentally pretty big biases towards public market, because the reason is, one of the things, if you look at in technology, every 10 years something new comes up. In 80s was mainframe, 90s was internet, so there's always something, And when the new thing comes out, people forget about the old things, and the massive multiple compression happen. And as the private company stays private for very long, you take a pretty significant risk that the next cycle, these companies multiple going to compress and going to holding the bag. And I have issues with companies staying private for very long. And I think we have created and continue to create a very bad habits of these companies staying private. I was at Snap. I've seen when you're a private company, we launch these cool things and people get excited. Guess what? The moment you go public, people only care about your EPS, and that's how you get judged. And I think we're creating this bad habits from this. Somebody launched a browser and everybody in media talks about the browser. And then 3 days later, you don't talk about that browser and nobody used that browser, And so I think that's a big thing. And then the third thing is in terms of bubble. Listen, there is some part of the market is expensive and there's some part of the market is not expensive. So I don't think we can call it blanketly that we're in a bubble by any means. The fact that we're talking about bubble is probably not a bubble.
Well, I just want to ask you as well, back to the use of AI in your fields, respective fields. So you mentioned about the opportunities. Maybe it's worth a bit more to also delve a bit more into the challenges, especially when it comes to accountability. When something goes wrong, who do we, ultimately hold culpable? And the human, the machine, the company that provides the software. What are we looking at here, and how do you see things shaping out in this area? Yeah, any of you? Yeah.
I can say, look, ultimately, I'm the portfolio manager. If I lose money, buck stops with me. I'm not going to blame a software company why I lose money. So
absolutely, it's just a question of the tools that you're using, and the human is ultimately responsible, even if he's not doing the trading, although we think he should be. But nonetheless, he's the one who designed the strategies, so he takes the hit at the end.
Yeah, I mean, I think it's an interesting moment because there are a lot of folk out there providing agentic and/or AI-enabled processing functions, where kind of LPs and asset managers outsourcing certain parts of their data acquisition strategies in other areas. But at the end of the day, I mean, we do use machine learning in a lot of the work we do to support clients across the implementation side, where we don't ever touch the cash, but we're involved in pulling in vast amounts of data. And we think it's critical that there's an expert in every loop when you're actually doing this work. And so you can create agentic processes with built-in validation steps to really try and ensure that you've eliminated hallucinations, but the variety of data formats and just the edge cases that exist are so numerous and vast and ongoing that you kind of need to always have those processes in place. And just going back to the kind of the extension of the bubble topic, look, at the end of the day, the valuations predict a complete remaking of the economy, right? I mean, this is predict, the amount of capex, the way that this has to actually flow through the market is just, it's setting us up for either some of these valuations are overdone or things are going to change dramatically. And then you have to then go to, well, how are companies actually going to adopt these technologies? And I think that's actually the key aspect for investors, is looking at organizations. And I really like the work of Ethan Mollick at Wharton. He had a Substack paper from back in May that has these sort of three sort of Venn diagrams in terms of organizational leadership, labs, and crowds. And I think it sort of certainly mirrors how we're operating, but I think when you look at corporations adopting AI, there's that kind of vision from top down about, how are you going to incorporate technology in this context going forward, and how do you empower the majority of your workforce as the crowd, recognizing that they're not going to put themselves out of a job in terms of innovation. So you need to see organizations with this top-down leadership, but they need some lab framework for innovation. And actually, I was in New York a couple of weeks ago, and in a kind of roundtable with the head of tech investing from some very large investment firms sharing their views, and exactly where my mind's been coming to, which is, you can have a CEO that has a vision, but actually the way things are sort of playing out with the agentification of various business processes, the CTO is then, there's a fourth diagram, circle that needs to be there, which is this intersection with your legacy technology team and their willingness to kind of overcome some of the data security and accuracy concerns so that you get the transmission mechanism right from the lab to the crowd. And that's going to decide the winners and losers going forward. But there's going to be some losers for sure. There's going to be value creation, but a huge amount of value destruction in the AI space, because that's just the reality of going through these stages, and it's not the first one. So, yeah.
Well, certainly many risks, but also potentially many rewards. And we're mindful of time now. Just like the end of the panel with just one question left, and all of you, I'd like to hear your thoughts on this. So if there was one lesson that you would like to tell the audience, people who are listening in, of what you've learned about using AI in your particular journeys, and also as well, or piece of advice that you'd like to offer them, what would this be, and how would you put it? Any of you?
That's a really interesting question. I would urge people to emphasize or reinforce their sense of humanity and look for the differences between the human and the machine. Whether you're trading or just in other life pursuits. In trading, I think that's actually where the edge comes from, is the human distinctiveness.
I think it's might be a very boring answer, but it's how much I'm more productive now. Like I use AI even to sort my email, like which email I need to respond earlier than others. It tells me. So it's really improving productivity. And I think that's where the whole capex things comes out, right? So if you think about $1.5 trillion capex, people said, oh, that's a lot. On a grand scheme of things, that's like what, 5% of US GDP. So the question you really have to ask yourself is that, are you going to see, instead of a 2% productivity improvement, are you going to see 3%, 4% productivity improvement? And what was the productivity again in mid-90s? And is AI productivity going to be faster than that? And if that productivity works, then you can pay for it. And the question, so really the main question is, are we going to be able to squeeze out the productivity? And then we'll be able to pay the capex. And if we're not, this capex is going to be a waste.
Yeah, and maybe I'd just add that the key aspect here is behavior change. That's the biggest challenge to adoption. And because it's going back to kind of incorporating these tools into people's daily lives. And so in an organization, you have to understand where are your different employees on the kind of innovation dispersion curve, from your early adopters and early majority, late majority. And so I think for anyone thinking about like how many times today have you already used agents? If you haven't, you should have done, right? And you should be looking for ways in which you can incorporate it into your daily lives. And I think that has to kind of flow from, throughout an organization. And I'm a big believer in kind of reading books on this topic to understand how we got where we are and some of the dystopian futures and or different ways we could go. There's some fantastic podcasts. So I'm just consuming. So I feel that's a key, is just staying abreast or being at conferences. But I think podcasts can give a lot of great insights. But then also, it's the one very good use for social media are the reels and shorts that show you like little bite-sized ways of using, an agent to just improve your email or whatever it might be. And I think just getting into the habit that you're embracing that behavior change and the discomfort, because that's going to be key.
Well, John, Dan, Imran, thank you so much. Ladies and gentlemen, a round of applause for our panelists over here.